Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining me for this segment, we have Jack Miller, Head of Global Execution Services at Baird, to discuss volume versus liquidity and innovating within the existing regulatory framework. Jack, it's great to see you as always. Welcome back to Trade Talks.
Great to see you too, Jill. Thanks for having me on.
You got it. And let's talk about these nuances here with volume versus liquidity. Sometimes the headlines don't always equal what these two words actually mean.
Yeah, totally. Well, I mean, as we're sitting here, as we speak today, we have markets that are at or near new highs after what's been a really strong late year rally, and just a couple of days removed from what appears to be a pretty clear signal from the Fed and belief by the markets that we're turning the corner into this rate cutting cycle that we've been anticipating really all through the year. And that has led to a flurry of institutional activity and liquidity really just over the last couple of weeks, as we've seen a cyclical rotation and portfolio rebalancing beginning to take place as a result of that change. And that really is a change versus what we had been seeing over most of the course of the year and what we've talked about earlier in the year, which is just less institutional activity overall, particularly in the framework of overall volumes. This is despite daily trading volumes on a nominal basis that are up still materially 50% or more relative to what we saw on a daily basis relative to pre-pandemic times. Various reasons for that. I mean, we've talked a lot about retail trading and the rise of self-directed retail investing and those contributions to overall volumes. But there's other things as well. The rise of passive investment strategies, which has kind of changed the liquidity landscape in terms of trading styles and the way that passive investors trade. We have volume in ETFs and other exchange traded products that are not common stocks. So that's included in the number. And if you strip that out, it tells a very different story. You have the increase in options volume and related dealer hedging activity and ancillary volumes that are created by that are kind of skewing the overall volume picture. And then the last thing I'd point out is just the behavior of the buy side themselves. I think there's a little bit of a game of chicken sometimes where, if you're finding less success finding liquidity, maybe you're a little bit less confident in showing your hand to the marketplace just because concerns about the information leakage associated with that. So bottom line, I think the way that we're continuing to try to help clients navigate the markets continues to evolve, and it remains a really challenging environment.
Yeah, and then you also have to consider in May as well, funds are going to have to contend with T+1. I mean, that's for domestic funds. I mean, there's a whole other layer of complexity when you think about global funds that have to adhere to it. How do you think T+1, at least for domestic funds, is going to impact?
Yeah, well, I mean, we have T+1 coming in May, and I think that we've known that this is coming for a long time, but I think we're at the point now as the calendar changes where, the rubber hits the road and those implementation plans have to get really dusted off and actually executed as we move into the first part of the year. This is a good thing. This is something that's generally something that the market is, industry participants are interested in seeing just because of what it does for systematic risk and basically reducing the amount of unsettled notional that's sitting out there. It's a good thing. It's operationally efficient, but it does come with some additional challenges and some additional requirements, namely among them, the need to affirm trades on trade date, which is a new requirement. It's going to cause investors of all types to have to change their workflow and potentially, I know you asked about domestic investors, but if you're overseas, extend your day late into the night because you're going to have to deal with, basically affirming trades on trade date so that they can settle on T+1. And that's before we even get into the settlement time mismatches that are created by just changing North America.
Yeah. Let's talk about the SEC and regulation here for a moment. We know there's some aggressive proposal rollouts that are there that could have an impact on market structure. And you also noted that there could be some unintended consequences here. Walk us through that a bit.
Yeah, so I mean, it was about a year ago that we got the early holiday gift of the 1,200 pages of market structure proposals from the SEC. And really, I think a year later, the only thing that's really changed after a period of digesting and understanding what the proposals were all about is a fairly broad industry consensus that the proposals are simply too broad, too sweeping, ultimately unnecessary, or possibly worse, and could be a step back in terms of market quality and investor outcomes. Even though the broad concepts behind each of the four proposals are things that many investors can get behind, whether that's tick size reform, making retail volume more accessible, we're still left after looking at these proposals, kind of asking the question, what is the problem that we're really trying to solve? And through the lens of institutional investors, at least, it doesn't appear that the proposals really address the fundamental problem that I talked about a minute ago, which is sourcing size liquidity. It may actually compound the problem.
Yeah, and what's interesting though, there still is innovation in the marketplace, despite some of the holdup that we might be getting from a regulatory perspective. Really, it's quite remarkable how the industry continues to move on, if you isolate it from a technology perspective.
It is. I mean, I think there's a premise behind the proposals that there needs to be a complete rewrite of the rule book and to, level the playing field, introduce competition into a marketplace that can be prone to some monopolistic tendencies. But anyone who deals with our markets on a daily basis knows that they are fiercely competitive. And if you look at the liquidity landscape now versus a couple of years ago, it has not been stagnant. You as an exchange, Nasdaq faces new competition. Retail wholesalers face new competition. Institutional brokers face new competition. So somewhere, someone is providing real innovation and real value that is causing customers to, reconsider, how and where they're trading. A case in point, venues, and Nasdaq has been at the center of this with the MLEO order type. It's an example of creating a type of interaction that appeals to a certain type of counterparty, so that they can optimize their interactions in the marketplace. And so even if you go back to something like the order competition rule, which was one of the most controversial items in the SEC proposals, it's aimed at this idea of breaking down the silo between institutional and retail. The point here is that some level of segmentation between different investors is actually probably a feature and not a bug of the marketplace, simply because different investor types have at times very different investment goals, different benchmarks, and different aims in how they trade. So the innovation has not stopped.
Right, it certainly hasn't. And Jack, you and I throughout the year have covered AI. Clearly it was one of the larger headlines of 2023. Have we yet to see the full impact of advances in Gen AI on the trading and investing world?
Well, not even close. And I think you made an important distinction between AI and Gen AI. And as we've talked about this before, if you look at trading algorithms and the way that the markets actually work on a micro basis, some AI concepts have been embedded into the marketplace for some time. And this is often at the micro level where we're talking about predicting the next tick or predicting things that are happening on a very short time scale and using those observations or predictions to improve the trading experience. In terms of Gen AI, that's really what's burst onto the scene in the last year. And I think as we've talked about before as well, it's something that's a lot more tangible, to individuals. It's part of our Thanksgiving table discussions, as it was in my family this year, where we're all thinking about what this really means for not just the workplace, but our culture. And we're not even close to seeing the full ramifications of it. In terms of trading, I mean, I think we really are going to see an impact is just through some of the natural language processing, the way that we consume news and research, the way we filter information, and ultimately how AI can be used as a tool to help enhance the investment process. And we're just in the early innings of that, and it's something that will be exciting to see how it folds out over the next couple of years.
All right, Jack, appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.